Welcome to The Money Movement, a show where we explore the issues and ideas driving this brave new world of digital currency and blockchains. We're back for a bonus episode, a second and perhaps a third bonus episode of Ask Me Anything. We kicked this off last week, had a tremendous number of great questions. You can follow those here on the YouTube channel and on social media, but we're going to keep answering those questions because we've gotten such positive response from this. So we're just going to dive right back in and hope you enjoy. This question came in from a Twitter user, GonzoMM. The user asks, which benefits does it bring to deploy USDC on a decentralized ledger instead of a centralized one? This is a really, I think, basic and fundamental question, which is why build stablecoins on public blockchains as opposed to private networks? And this gets to the very core of digital currency and the promise of digital currency. The ultimate benefits of this technology are in a world where everyone everywhere can connect to open networks. In the same way with the World Wide Web, anyone can put up a web server and make their content available through HTTP, and any device in the world that has a web browser can access that information. It's an open network, and that open, permissionless, decentralized infrastructure is what makes the internet so valuable. It allows people and businesses everywhere to freely interact and communicate. And public blockchains and what are really permissionless blockchains really present to the world that same opportunity, but with infrastructure which can be used for settling transactions or more sophisticated contracts between individuals, entities, and others in the same kind of open way. And so what the World Wide Web or internet email did for sharing information or communications, public chains will do for value exchange. And that's why, as a first principle, USDC is designed to run on public networks. And that's, again, really critical to getting all the benefits of interoperability, global reach, and global participation. This next question is from Tom at Circle. Thank you, Tom. You always ask guests where you think we'll be in terms of adoption within the next 3 to 5 years. Where do you believe we'll be in terms of adoption within the next 3 to 5 years? And what are some interesting use cases you believe will catapult adoption exponentially? This is something that we think about all the time. And as I tell a lot of people, when we started Circle 7 years ago in 2013, what I told our first investors and our employees and continue to over the years is that we envisioned a world where sharing value, whether it be between people or people and businesses, would become a ubiquitous free service on the internet. That we would be able to do it with the same ease that we do share content and data. And that public blockchains and ideas like fiat digital currencies, what we're talking about now as stablecoins, would make that possible. And I believe that that first phase of this sort of new global economic system built on the internet, that first phase would probably take between 5 and 10 years. So now we're about 7 years into that, and we're kind of right on time. I think that the technology is now in a place where we can scale that out. The regulatory clarity is coming into place, and major consumer technology companies, governments, and innovators are realizing these ideas. So now I think the next 3 years, which would take us to the 10 years from when we got started, I think we're going to go through that transformation where just like we all take for granted now that we can just do a free video call with anyone over the internet. I think in 3 to 5 years, we'll just take for granted that you can settle a transaction between anyone and any person in business instantly for free. That doesn't mean that will take over all transactions in the world, but that'll be possible. Just like we still use mobile phone numbers and the legacy telephone system for a variety of communications. We still have cable TV subscriptions or satellite TV subscriptions in many cases, but the ability to do all these things will be ubiquitous. So the first is just free, ubiquitous payments for everyone who chooses to participate in that system. I think the second, and really the more interesting, is what are people going to do on top of this? The whole premise here is that we have money becoming essentially a new data type on the internet. And when you have a new data type on the internet and you have a system that allows it to be composable and programmable, then you start to see really interesting things happen. And so I think the innovations are going to be in the delivery of what we think of today as financial services, but many of those capabilities being offered through automated open infrastructure on the internet, what we think of as DeFi today. So saving money, investing money, earning money, mediating different types of financial contracts, a lot of that moving to this infrastructure. I think the most interesting thing is that I don't think any of us have any idea what the breakthroughs are going to be. I often use the example of, there were smartphones for a really long time, but cell connectivity was really slow, and the quality of the operating systems on those smartphones were quite poor. You couldn't build really easy to use applications, and it really took until 2008 when there was a smartphone, which was the iPhone, which had an app store where people could create interesting usable applications for the phone, combined with the introduction of third generation cell connectivity, 3G, which allowed for enough bandwidth that you could actually start to have higher performing applications. It wasn't just something that was local. It could be a connected application. And then the third is, Apple put, and many other mobile phone makers put GPS radios in their devices. And most people thought, oh, that's great. We're going to be able to replace our turn-by-turn navigation system with this or whatnot. But what became possible was this combination of things that allowed an entrepreneur to come along and say, you know what? I can reinvent the way transportation works. I can reinvent the way logistics works. And that gave birth to companies like Uber and Lyft and others. And so I think that this idea of programmable money and public blockchains and stablecoins, the synthesis of all these things are going to open up things that none of us have even thought of. So in terms of use cases, I think we've got a lot to look forward to. This next question is from Twitter, from Twitter handle G Stablecoins. Thanks, G Stablecoins. The question is, KYC, or Know Your Customer, is a major regulatory hurdle for the mainstream adoption of stablecoins and financial inclusivity at global scale. Do you envisage a practical solution that can be agreed upon internationally anytime soon? If so, what do you think that might look like? Well, so there are standards emerging in this space, and crucially, a little over a year ago, in June of 2019, the body that the international body that sets standards for things like what's expected for Know Your Customer activities in the financial system, the Financial Action Task Force, or FATF, put forward a set of guidelines that they expected all members of FATF, which is pretty much every country in the world, to adopt specifically around what they call virtual asset service providers, or VASPs. And those guidelines specifically deal with what's expected for firms to have Know Your Customer programs. So if you're a business that is involved in the delivery of wallet services or exchange services or payment services, and you're building on this digital currency technology, there are expectations that you will perform Know Your Customer. And the additional piece here is that set of guidelines really said to the industry, hey, we want you to come up with standards for how this can be working interoperably across different service providers around the world. So if I'm using a service from, say a Circle, and someone else is using a service from a company in Argentina or a company in, Korea or Germany or wherever, that we also have ways to kind of assure each other that our users have been KYC'd and ways to meet what are described as sort of record-keeping obligations that those firms have. So there are standards emerging for that, and those standards are coming from the private sector, and we expect to see what's called travel rule protocol that gets wide adoption starting in the beginning of next year. So I think those are the practical solutions. I think this is an area that needs a lot of attention from a technical innovation perspective, ensuring that individuals everywhere can participate in these, the benefits of this technology, and not create such an inordinate burden that it's impossible for an individual who has a mobile phone to participate and be excluded. So I'm cautiously optimistic on that. Here's another question from another Twitter user. This question is from Zoom Call Saul. Zoom Call Saul asks, how do you see competition between multiple stablecoins panning out? Will there be consolidation? I think we've seen over the past few years within the digital asset industry a lot of proliferation in stablecoins. I don't know the total number of stablecoin projects that are out there, but there are certainly dozens of dollar stablecoin projects, and then there are maybe altogether as many as 100 other stablecoin projects. What you have seen is market consolidation around a very limited number. I think in the early phases of this market, because so much of the usage has been tied to digital asset markets activity, the dollar stablecoins have been the stablecoins that are most heavily utilized as a way to settle transactions and price things in these markets. And we've definitely seen a real separation of leader, stablecoins that are really kind of leading the way and getting adoption from the broader ecosystem. So I do believe there'll be market consolidation. I don't necessarily think there's going to be consolidation of stablecoins themselves. I don't think you'll see one stablecoin project merging with another stablecoin project. I think much rather you're going to see just the share of the market kind of consolidate. And that's because it's really important, especially when you think about the internet, that there are standards that people can rely upon that allow things to be interoperable. If there were 10 different protocols for sharing content on the internet beyond the web, that would be really challenging. But the world adopted HTTP, and that allowed for an enormous amount of interoperability in terms of how computers and then people and businesses could share information with each other on the internet. And I think with fiat digital currencies and their representation, whether you be a financial institution, a fintech, a merchant, a business, an individual, you're going to want to know that your digital dollar transactions kind of work everywhere. And so I do think that naturally the market will tend towards standards, and we're seeing kind of early, I think, versions of that right now. Moving on, we have another question from Fabricio Tota, who's the CEO or I believe head of business development strategy for Mercado Bitcoin, a leading Brazilian digital asset exchange, and I believe one that also supports USDC, and previous guest on the Money Movement. Thank you, Fabricio. Question is, USDC is a global asset. Although the idea of a stablecoin is very powerful, how do you see the impact of different jurisdictions' regulation on USDC? This is obviously a very fast-moving topic. On the one hand, you're seeing the private sector all around the world, entrepreneurs, innovators, building and adopting on top of these emerging stablecoins. And that's really driving a huge amount of growth in trading and settlement and payments, in decentralized finance applications. All of these are driving a lot of growth. And that's very much global. As you said, USDC is a global asset. Many countries are just now, I think, starting to get their arms wrapped around the sort of birth of internet native digital money. And some of that is really focused on rules and regulations around firms within their countries that are going to participate in these markets or provide, services to people and businesses, and making sure that they're registered, licensed, have anti-money laundering programs in place. I think that's by far the most common thing. And now we're seeing the beginnings of global policy coordination around stablecoins, most notably the Group of 20, which I think covers a very large percentage of the global economy. The financial ministers and central bankers and others from the G20 have been active in a working group around stablecoins and putting forward recommended policies for G20 members, which I think ultimately would be policies that would be likely considered, if not adopted, by most countries in the world. And these define, expectations for how financial firms, issuers themselves might operate on a global basis. And I think that kind of commonality is going to be really, really important because, as you say, a digital currency, whether it's a digital currency like USDC or a native digital currency like Bitcoin, are inherently global. They exist by definition everywhere the internet exists, and even beyond. And so, having some commonality around that is really important, so that people everywhere understand how they can interact with and take advantage of these innovations. A follow-up question from Fabricio was, DeFi, is it too early to say DeFi, specifically stablecoin-based borrowing and lending, is the killer app on Ethereum? It is interesting. I think the synthesis of stablecoins and decentralized finance protocols, that synthesis together appears to be the killer app on Ethereum right now. It's been a tremendous amount of growth and activity, and I think they're mutually reinforcing, right? To have a stablecoin like USDC, which is a regulated stablecoin that is full reserve, that is redeemable, that has the appropriate audit and information security and other standards built around it, allows people to know that this is a stored value instrument that they can rely upon. And that's really important if you're then using a stablecoin like this in a decentralized infrastructure like a compound protocol or the many others that have emerged. But that combination is really powerful, and I think is the killer app for Ethereum, and arguably sort of the killer app of these smart contract public blockchains right now as well. Another question here. This is from a former guest on the Money Movement, Ronnie Phillips, Professor Emeritus of Economics at Colorado State University, someone who we had on the show to talk about the Chicago Plan, which was a plan put forward in the throes of the Great Depression from leading economists around really the idea of full reserve banking as opposed to fractional reserve banking and what that could mean. We talked about that in the context of stablecoins. We'll try and put a link into that episode here. Ronnie's question is, given the developments in technology and the increased competition from the private sector, do you think the Federal Reserve can and should play a smaller role in the payment system? It's a really good question. I think every part of the world is different. In China, for example, the government is very heavily involved in the development of core infrastructure. But even in China, there's intense cooperation between large private enterprises and the government. And there are, state-sponsored initiatives that depend upon work that government does and work that the private sector does in combination. And the recent digital currency effort, the DCEP out of China, is an example of that. When you look at the West, you look at the development of the Western economic system, especially post World War II, but certainly before as well. The private sector has played a much larger role in payment systems and payment system innovations. When you think about electronic money, the first real version of electronic money that we kind of all can relate to is the bank wire. And that bank wire system was really driven by a set of private sector players coming up with standards through an association, that association is known as SWIFT, for how to send these wire messages back and forth. And that organization was basically a membership-based organization of private financial institutions, but it worked really closely with central banks to ultimately get that to function well. When the next major electronic money innovation came along, say, Visa and MasterCard, but in the 70s and 80s, that was also a consortium of private sector actors who were creating technology for these magstripe cards and terminals and how to get that to kind of reconcile, using the underlying, settlement systems that the banks had in place, but improving upon it, building another layer of electronic money innovation on top of it. And again, there it was really a consortium of private sector actors, but of course, working in consultation with regulators, the regulators, including the Federal Reserve, the OCC at the Treasury Department, and others in different states who oversee the financial institutions that were innovating in this way. And I think that's what we're seeing now. We're continuing to see private sector-led innovation accelerating in this new type of electronic money, digital currency money, and moving at a very, very fast pace. And potentially a pace where within 3 to 5 years, as we talked about in another question, billions of people could be using this. It does not seem likely to me that the Federal Reserve is going to run at the same pace. And nor do I think it's really set up to be a technology innovation organization. I think the Fed has a really critical role in terms of R&D in this space to really deeply evaluate the kinds of standards that the Fed would expect to have in place around security, around safety and soundness. And I think there's a tremendous opportunity for collaboration, as we've seen historically in the development of other forms of electronic money, collaboration between the Federal Reserve, the US Treasury Department with the private sector to develop this next world of internet-based money and an economic system built on the internet. Next question. Okay. This is a question from Julian Hall from Bank Frick in Europe, a neobank that has been innovating in digital assets. The question is, a lot of talk is currently going on in regards to worldwide inflation, but also concerning the US dollar. On the one hand, what is your take on that? And on the other hand, since USDC is a digital representation of the US dollar, how do you think what do you think the effect will be on the adoption of USDC? And how do you plan to counter these effects? Not inflation, but the effect on the adoption and widespread use of USDC. This is a really great question. And I think one of the themes that we've seen in the growth of stablecoins, in particular digital dollar stablecoins like USDC, over the past 6+ months in the context of COVID and the global economic crisis that is taking place, is there are many people in the world who are living in places where the assurance of their government to stand behind, say, their own currency is weaker. And governments everywhere are spending at deficit levels that are unprecedented. We know that here in the US, it's at an incredible level. And in every country in the world, though, more or less, you're seeing this giant issuance of government debt that it's not clear people can pay for and will be monetized through effectively issuing more currency. And that raises significant questions, very significant global questions. I think that is obviously an argument for non-sovereign money. It's an argument for the growth of Bitcoin as well. But at the same time, people need to transact in stable value currencies, and the dollar remains the preeminent settlement currency for transactions around the world. And so the demand, I think, will continue. And I think the shift from either foreign currencies or sort of legacy commercial bank electronic money into digital currency versions of electronic money will continue. It will continue at a significant rate, and that will grow, even if we're seeing a weakening of the dollar itself. The sort of growth in its usage, the conversion of existing forms of dollars into digital dollar stablecoins, I think will grow at a very significant clip, even if we're seeing the global role of the dollar shifting a little bit as well. But there's a lot going on in that question, and it's certainly something that we've been exploring a lot here on the Money Movement. Another question here. This is from Luis Huende, who is a co-founder and head of the Aragon Association, previous guest on the Money Movement, a really awesome project helping build decentralized communities through blockchains. And Luis is asking, when will be achieved Stripe-alike user experiences for onboarding from fiat to USDC? He says, I know the settlement time for credit card networks is definitely an issue. Just curious about avenues to work around it. Well, what I can say there is I think that those types of user experiences are imminent. And Circle is certainly working on things in that space. And other third-party companies are also working on things in that space. And, it's one of the things that I think people need to understand when understanding the way that existing kind of payment rails work and then these new digital currency payment rails, there's a huge difference. So in, say, the card network payment rails, settlement of funds actually takes days between when you say, here's my instruction to make a payment, and when the actual, say, merchant receives the payment. Now, there are effectively a set of assurances that different parties on those networks make, which gives the coffee shop owner or the e-commerce merchant confidence that the funds will eventually arrive. And so that's really important. Now, with digital currency, if you're, say, using a credit card or a debit card to get digital currency is a technology that can be used in irreversible transactions. And so there's just an increased amount of fraud risk. There's very, very common scenarios where, cyber criminals are taking stolen identities and stolen credit cards, and they find an avenue where they can take those, essentially convert them into crypto, and then send the crypto off and it's gone. And then the person who had their stolen credentials says, hey, I didn't do this, and issues a chargeback. And then the service that's providing that sort of crypto for cards is on the hook for the chargeback and on the hook for the lost digital currency that just went off into the internet. So it's an area that requires a lot of work, but very much a solvable problem. In earlier days, Circle in our Circle Pay app enabled instant transactions, and you can expect to see those kinds of solutions very, very soon for USDC. It's a good question. This is from another former guest of the Money Movement, Paul Rosvoneberg from Allaire Finance, a really cool streaming payments protocol project. Question from Paul is, USDC is an upgradable smart contract. Does Circle have in mind the prospect of a native interest rate payable directly to USDC holders? So a couple things here. The first is, so USDC, the standards for the technology and the functionality and what's possible is governed by Center Consortium. That includes Coinbase and Circle, and there are other third-party developers that are contributing to the ongoing development of the protocol itself. And that's all open source. That's up on GitHub. There's a major upgrade recently to USDC into the version 2 of the smart contract. That was the first time USDC had seen any upgrade since it launched 2 years ago. And I think we're quite sensitive about making changes because we're dealing with essentially a dollar payment system that you have to be extremely careful about changes to. The idea of sort of USDC token holders being able to be paid a native interest rate is a really interesting one. And I think it's something that, perhaps financial institutions that are issuers of USDC or other financial institutions that are interacting with USDC might be interested in being able to do. But it isn't necessarily something that Center itself can do, because Center is just a sort of standards and governance organization. But the idea of creating features in USDC that allow for kind of payments into USDC token holders is definitely something that we've talked about. Stay tuned. We've got a whole bunch of questions here from Perry Ann Boring and her colleague Patrick South from the Chamber of Digital Commerce, another former guest on the Money Movement. I'm not going to get through all of these questions at once, but I'll try and knock off a couple of them. It's 2030. How is the average citizen using USDC or stablecoins generally versus digital currencies issued by central banks? So in my mind, what is that, 10 years? 10 years from now, we will almost certainly be in a world where central banks have worked with large consortiums of financial technology and financial institutions who've built out really broad, widely adopted stablecoin networks and standards. And at that point in time, I think these standards will be everywhere. They'll be ubiquitous. Everyone connected to the internet will be using these. The exchange of value will be just a global frictionless experience. And at that point, it's not clear to me that central banks everywhere will be issuing digital currencies, but they will be supervising the issuance of digital currencies. They'll be supervising financial institutions that are connected to their core underlying money and providing infrastructure, account infrastructure to firms that are issuing digital currencies. And then, of course, really ensuring that the standards meet all of the right kind of supervisory expectations of central banks. So again, I see a world of public-private sector collaboration, not a world where private companies are competing with central bank issued digital currency. I think those really converge over the coming years. Another question here from the same. We've seen some regulatory concentration around stablecoins this year. The FSB Global Stablecoin Consultation, the OCC Interpretive Letter. What's the ideal regulatory framework, in your opinion, that enables stablecoin adoption to continue proliferating while balancing consumer protection and AML considerations? I think we're getting closer on this, and we participated actively in the Financial Stability Board's working group research in the space and in consultation on what may emerge as standards from the FSB. And I think having standards around issuers, around the safety and soundness of the reserves, the information security audit, and other kind of control functions that are needed around stablecoins, which are unique and different than other prior forms of electronic money. Most of these are all really issues around integrity, safety, soundness, which are ultimately consumer protection and protection of the economy kind of issues. I think a lot of the recommendations that are emerging there make a lot of sense. Existing banking and payments regulatory frameworks don't really address some of the unique things with blockchains and digital currency. So there's going to need to be some flexibility around the innovations that become possible. For example, the global reach of a stablecoin, the programmability of a stablecoin. These just aren't things that are possible in the legacy financial system, but bring huge benefits to users of this technology. And so adapting to that is going to be really key. And I think regulators having an open mind about the fact that digital money exists everywhere the internet exists, that code can interact with money in an autonomous way out on the internet. These at face value might make regulators feel really uncomfortable, but I think are things that will unleash incredible value for society, the economy as a whole. So, but we need to think through what are the risks that come with those and how do we mitigate those. And so there's likely, new things that are needed there. In terms of anti-money laundering and countering terrorism finance considerations, I think there's still a lot of work to do. I think the existing frameworks that through the Bank Secrecy Act, through FATF, that exist around how financial institutions track transactions and exchange information about transactions, the current financial system leaves a huge amount to be improved. We know that something close to 98% of money laundering escapes detection. We see reports all the time of vast amounts of criminal activity that are either underreported or weakly reported or not followed up on. And the head of FinCEN in Senate testimony, I sat next to her a number of years ago. At the time, made it clear that we have a $2 trillion money laundering problem with the U.S. dollar today. So it's a problem that exists in an enormous way. And the systems that are in place today, which effectively have various types of record keeping and information exchange between financial institutions, need improvement. And the FATF standards for what is called the travel rule, which will have these virtual asset service providers exchanging sensitive personal identifiable information over the internet with lots of other firms, while at face value meets the kind of letter of the law, I think will contribute to ultimately more challenges for end users and more risks. the mass proliferation of sensitive personal information over the internet is an issue that haunts many people on a regular basis. And I think some of the regulations that are there are going to lead to increases in data breaches with financial institutions. And so, there's a lot of work to still do there. I think it's, in a world of internet money, in a world of digital value being able to be transmitted in milliseconds between any device anywhere in the world, that's just not something that anti-money laundering policymakers and regulators have really contemplated. And I think just taking the old system and trying to apply it is going to be inadequate. This also ties into the need for significant improvements in digital identity standards, in self-sovereign identity standards, and the intersection between identity standards and these kinds of anti-money laundering considerations, and then the intersection of all of that with privacy technologies. So I think the good news here is there's incredible amounts of innovation happening in what's possible with payments and money transmission, what's possible with identity, and providing more secure forms of identity than we've had before, and the ability to enhance and increase privacy while also maintaining appropriate controls around abuse. So there's a lot of work to do there. We're certainly not close to being done. And another question here from Patrick. We're 20 episodes in and I still can't figure out what apparently very select books are on the shelves behind you. What are they? It's a great question. I'll let you know. One book is Michael Lewis, Flash Boys, which is about high frequency trading. And another book is Blockchain and the New Architecture of Trust by none other than Kevin Warbach, who has been a guest on the show. The third book is World Orders Old and New by Noam Chomsky, the political and economic critic. The next book is Dealing with China by former Secretary of Treasury, Hank Paulson. And the fourth book is a biography of Benjamin Franklin. So there you have it. Next question is from Danelle Dixon, who is from Stellar and the Stellar Foundation. And she asks, today there are a number of major USD stablecoins in the market, each with its own niche. How do you see the competitive landscape for stablecoins evolving in the coming years? Is there room for many different flavors of USD coin, or is it a winner-take-all scenario? This relates to an earlier question. I think our view is that you'll see increasing market consolidation around very likely a couple of standards for dollar stablecoins. I think in the internet space, developers and businesses converge around standards because once you have those, you get massive global network effects that come from it. And I think with communications, with data sharing, with information sharing, the benefits of that have been enormous. And I think you'll see very similar in the exchange of value. So I don't see a huge number of different flavors of US dollar stablecoins. I think it'll be a more limited number. However, I do think we're going to see significant growth in stablecoins in markets all around the world. I mean, the benefits of a digital dollar are no different than the benefits of a digital rand or a digital Korean won or a digital rupee. All of these currencies are going to want to participate in the public internet economic system. They're going to want to participate in the innovation in public blockchains. And so I do expect to see proliferation of many of the, not just reserve currencies, emerging market currencies, and other sovereign currencies into stablecoins, very likely driven by private sector innovators, sometimes in collaboration with central banks. And I think our hope is that standards organizations like Center Consortium can provide a model for other issuers. And those standards, the standards that Center has built around USD coin, have got relevance everywhere. So these are fiduciary standards, information security standards, administrative control standards, audit and reporting standards, regulatory and compliance standards, and the actual protocols themselves. So if we have consistent protocols for fiat digital currency and we have consistent standards, I think that creates kind of the ultimate benefit for users, people and businesses that can depend on it and know it's kind of built on those common standards. We are going to take a break here and pick up in another AMA response session in just a few minutes.